Hey guys, Kevin Bopp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Our guest for this week's show is commercial real estate expert Drew Wahlgren. Drew is the co-founder and director of capital markets for MAG Capital Partners. MAG Capital specializes in sale-leasebacks, net lease investments, and various development projects throughout the U.S. And so with that, guys, it's an honor to welcome my guest for today's show, Drew Wahlgren. Drew, how you doing today?
Kevin, good. Thanks for having me on here.
Yeah, excited to have you. Looking forward to chatting with you about your business, your background, and everything in between. So with that, why don't we start with you, Drew? For those folks that aren't familiar with you, that don't know anything about you, take a few minutes, tell us a little bit more about yourself, your background, and then ultimately how you found your way into this niche.
I'll keep it as short as I can here, but my name is Drew Wahlgren. I'm Director of Capital Markets here at MAG Capital Partners. We're a commercial real estate investment firm. So what that means, past the title really, is that I'm working with lenders as we line up debt for acquisitions we make in commercial real estate, but also working with investors as they join us and place equity in these large acquisitions. So in short, the layman's terms is, we syndicate some of the equity out with some investors. So working on that end to line up the capital before we close on an acquisition. And as far as how I found myself here, I found myself investing as an LP a long time ago. I sold a house and I said, do I want to become a landlord here? And I had already been exposed to the commercial syndication side and passive investing, and I was really attracted to that. And part of it was kind of, know thyself, right? And I'm like, if I hold this house, and I didn't move too far away, so I'm going, if I hold this house and rent it out, I'm never going to see my kids again. I'm going to be over there, getting into their business, and I'm going to be too involved, and that's a problem for me. And again, this is kind of a personal fault of my own. I'm just a little too DIY, a little too hands-on. So I kind of put myself in a position where I couldn't fall into that trap, tenants and toilets, what people talk about. So I said, this is great. I'm going to take proceeds. I had lived in that house for 5 years. This was my house I lived in, not an investment property. So, but huge gains on a great time in the market, after 2010. And I'm here in the Bay Area, California. So you can imagine things get pretty wild pretty fast. But when you can take $500,000 without any capital gains and reinvest it, my God, I was like a kid in a candy shop. And I'm like, what's out there, right? I was pretty excited to jump in and start redeploying that cash into commercial real estate investments. So really, I just got a lot of that there. And my brother worked for a sort of capital raising organization. They were a co-sponsor with a few true operators out there. And so he had kind of introduced me to these different operators, and I had been looking at deals and doing all that. And one day, years later, he said, I'm ready to do, this isn't working out for me where I'm at. And I said the same thing. I was at a W-2 job the whole time, working for corporate America, always kind of hearkening back to days in my early 20s when I had my own business, kind of going, I miss that. And so I said, yes, let's jump out of here. We can raise capital. We know this world. We know investors. Let's bring them into deals and find some operators that we really like. And to be honest, it didn't take long for us to look around and say, you know what, we're close with the guys at MAG Capital Partners. I like them. I had already invested my money with them personally. So I was really attracted to the strategy and what was there already. I said, this makes tons of sense for me. They need some help bringing more capital here and kind of opening up the bottleneck, which could be equity, right? And raising capital for equity on new acquisitions, because you have this great operation working, but you need that money to fuel it. And so it's just a matter of getting in front of people and telling people, hey, this is what we're doing out here, and it makes a lot of sense. And it's just been a great road since then for the past, 2.5 years or so since we joined. And my brother and I joined together, and it's really just kind of opened up a lot of doors and given us a lot more opportunity for larger deals, because now we've taken out that bottleneck.
Yeah, interesting. So obviously you had done some research, you sold that property, you had your capital in place, you had done some research on various different sponsors. That's how you came across MAG Capital Partners. But when you decided to approach them, knowing that you wanted to get more involved, you wanted to become part of the team, did you identify that might have been one of their, not necessarily a weak link, that's probably the wrong terminology to use, but ultimately that that part of the business where they definitely could use some value add, additional equity, bringing it into, facilitate deals. Was that somewhat of a void?
At the time, I didn't know that that was a bottleneck. In hindsight,
Okay.
I said, "Oh, there was lots of opportunities," but now it became a question of, who do you partner with to bring that in? And
Hmm.
if you've seen across syndications across the industry, a lot of partnerships like that happening, right? Great operators with a lot of experience that don't have a huge network, or maybe they've tapped them out, right? It's friends and family first. That's generally how people get
Yeah.
started, and it's the case for us as well. Kind of going back 6, 7, 8 years with the principals here. And, eventually your friends and family go, look, you have all my money and you're doing great with it. But until you sell something, I don't just get, 50K every month or two to deploy. Right. So that's, people do get tapped out. And so you want to eventually start, reaping and harvesting some of these deals and you return capital. And that really helps, fuel your future acquisitions. But it's always kind of a constant, I don't want to say we're on a hamster wheel, but you always have to be expanding your network, right? There always has to be, if you want to keep growing as an investment firm. So I know we're going to talk a little bit more about what we do, but we do,
Yeah.
triple net lease deals, and they're very passive for us as a sponsor, as a landlord, right? And that's kind of by design, right? We don't want to get caught up and mired in a lot of these details. We want to continue to scale. Okay, we've got a long-term net lease investment. We don't have to start renovating the property. We don't need to start leasing up spaces. These aren't a value add investment. So because of that, you're able to close on that. And there's a little back end work. Maybe you do a cost segregation study and you're following up with a tenant every quarter or so. But generally, you can now turn your focus onto other opportunities and acquisitions. So it's very, it's an easy way to scale, but you do need to make sure you have a really healthy group of investors behind you that are going, look, we understand and appreciate what you're doing here, and we're ready to kind of jump in with you. So I know I talked a little bit about that, but that's kind of part of that evolution and how we sort of have grown as a firm.
Yeah, I don't want to get off track here, but you'd brought up, possibly doing a cost seg study, and so I definitely want to hit on, maybe we get later in the show we can talk about the tax efficiencies associated with these typical type of investments, and so maybe plug that in the back of your mind because that's definitely something of importance to investors out there as well. But let's start with the basics. Sale-Leaseback Strategy. Let's just, plain and simple, what is it? Give me the highlighted overview.
It's the greatest. It's the greatest. I'm just kidding. I'll move right into it. It's we're really purchasing a property from a commercial business who's generally operated in a property for a long time, right? This is our experience at least. And they're getting to a point where they look around and go, hey, we're continuing to grow our company. And essentially they don't have to do a sale leaseback. They could find other forms of financing to grow their company. But the sale leaseback has become more popular. It's become more well known as a financing instrument. So they're going, hey, I could go get bank financing, but that comes with a lot of covenants. That comes with a lot of rules. I need to sort of keep myself within some of these, and I have to be careful not to default and break those rules here. I could pull a line of credit off a property I own, but I'm only going to get 70%. Right? If you've looked at, done that on your own house, for instance, you'll see you're not going to get 100% of the equity out. But if I do a sale leaseback, I can access 100% of that. And generally anyone like us who's in real estate investing will say, "Why would you do that?" No, we're real estate investors. We don't ever think of selling a property unless you're reaping a nice profit there. We think, no, there's more value in owning the asset, right? But for these guys, you got to remember they have an opportunity cost. They're running a business. They're going, hey, I can take $10 million out here and 3x the size of my company by buying new equipment for a new product line, or just maybe recapitalizing our balance sheet after we just made a couple moves, right? We use some traditional financing and now we want to sort of recapitalize our balance sheet and get to a healthy positioning. And so either way, they're using the proceeds generally to strengthen the company. And that's a great thing as a landlord. You go, if we do this sale leaseback with them, they're going to come out the other end of this transaction as a stronger tenant. And that's what we want. So what we're doing, we're buying this property from them and simultaneously upon closing, signing a long-term triple net lease. So it's great for them. They have a very, they're kind of insulating themselves from, market swings and rents or what have you. And generally they're trading in a little bit of that rent what you might find in a little bit higher rent, getting a little bit lower rent rate by taking on that triple net term. They're exchanging some of that rent that they have to pay for responsibilities,
Hmm.
taking on insurance, taxes, maintenance, so on and so forth. So it's a very nice instrument for them. And for us, of course, we're at the front end of an institutional grade lease that we've crafted. We build in institutional features, the things that we've studied publicly traded REITs and what they look for and how they structure their leases, because we might hold this thing, I'll put it like this. You might sign a 20-year lease, and in 5 years, you may be looking to unload. And at that point, a buyer, an institutional buyer, is going to say, well, let's see the lease. If this is a bad lease, no thanks. But if
Right.
they go, look, you have annual rent bumps in here, you have quarterly financial reporting required from this tenant, audited financial reporting, strong force majeure clauses, all these things. A lot of what we're building here and a little bit of value that we're bringing in the front end is contractual value. It's coming in having a very high quality tenant sign a 20-year lease. That's worth something. Anyone can come into this and have a very reliable cash flow with no expenses, and that's what we enjoy, at least for the whole period that we have. Consistent cash flow. I have a single tenant, no vacancies, I have no expenses, and it's cash flows from day one, right? We close, this tenant's already in place and they're paying rent. So that's a really beautiful part about that structure, is that you have a great entry level day one cash flow, and you have a really nice exit out in even 5 years here, because you have 10 to 15 years left on this lease. It's still a very stabilized asset.
And on the buy side, are you guys typically putting debt on these properties, or are you buying them all cash?
We're using debt, absolutely.
Okay.
70-75% leverage typically, and the
That's
remainder is
beautiful.
equity.
Wow, absolutely. So the typical term is 20 years. Are there typical do you normally putting, you'd mentioned that a lot of times that the cash that these companies are getting from the sale of their building, of their property, most of the time they're going to be utilizing that capital to grow their business, to buy equipment, to hire additional staff, whatever it might be. Are there covenants that you typically put in place that require them to do those things, or no? Are you not involved at all in that side of it?
No, we don't require anything.
Okay,
We really, it's just a matter of getting their intentions,
got it.
right? Go, look, what's the plan here? Why are we doing a sale leaseback? And, generally you could see just on paper, right? You're looking at their financials and the story of the company. And
Hmm.
sometimes you're finding, okay, these guys just acquired a competitor, let's say, hey, we bought this other business, we rolled it up into our own, we just doubled revenues. It's a great thing. However, how do they buy it? Maybe they spend 20 million bucks. Well, typically they're using some financing, and maybe it was an opportunity that they needed to jump on, and then afterwards now they're looking to recapitalize. So you kind of can see a lot of that when they tell you, hey, this is why we're using it. You could really see, get inside the head of the leadership of a company. You go, okay, I see exactly what they're doing. So we're going, again, spending weeks and months with this tenant to kind of put together due diligence. And we have an internal credit team that we've hired from the institutions. We've
Hmm.
watch them and see how the greats do it, and we've taken their people because they do a fantastic job. And so these guys do tons of calls, tons of analysis of the financials, and they're willing to share all that with us because they're the seller, right? If
Yeah.
you have a third party seller and another tenant, a tenant might say, hey, screw you. You want to look at my financials? I don't owe you anything. But in this case, in a sale leaseback, they're willing to share all that with you because they want you to
Sure.
get comfortable with the deal as well. So these guys do a lot there. They put together an institutional grade credit memo, which we're able to kind of share with our banking partners, our equity
Yeah.
partners, and they can really see, hey, here's all the due diligence synthesized in this document.
Yeah, I mean, so you're basically de-risking it for your debt partners as well. It's a beautiful thing. Um, what's a typical transaction size for your group?
Anywhere from 5 to 20 million. I mean, we
Okay.
just closed on one recently, over 20 million. We're going to be closing by the end of the year on one that's four. Sometimes you just find that a great opportunity, and it's hard to pass up.
I'd love to hear a case study of, obviously you're looking at a lot of deals, you're filtering through a lot of not so great opportunities to find those needles in the haystack. Maybe give us a high overview of a deal that maybe from the outside looking in looked somewhat attractive, and as you guys dug a little deeper, you decided to pass on it. And what were the reasons for passing?
Sure, I got a great one. There's one, and this is close to my heart because I work with lenders and the equity partners, and you have to understand how people are thinking and what they're going to be attracted to, because ultimately you have to get particular kind of financing maybe for an acquisition. And we were in contract for a two property portfolio in northern Missouri. It was a food processing company, had a little bit of a cold storage element to it, about 25% of the property. And quite frankly, it was very built out for their operation. They were smoking meats and meat snacks and, doing a lot of private label manufacturing for brands across the country. So really great business. Meat snacks has gone up, 8% on average per year. And, this is the kind of thing I remember because we do a lot of our due diligence on the company, on the industry that they're in. So we operate a little bit like a private equity group in that way. But going back to these guys, the problem here for this acquisition and why we eventually had to say, you know what, this isn't going to work is, lending partners that are going to join you, they look at some of these risk profiles similarly, but in a little bit differently than maybe an equity investor was. There's a lot of things though that you look at the same. You go, okay, what are the risks around here? And at the end of the day, you kind of look at this thing, you go, okay, it's a very specialized build out. And what will it take if you do have a tenant default? What will we do here? And a standard industrial property is four walls and a roof. You can do anything, right? A manufacturing tenant wants to come in. Amazon wants to set up a last mile delivery center. I mean, it's all just open space. You can set up pallet racks, whatever you want to do. And some of that comes down to truck bays and things like that. But really, ultimately, there's a lot more versatility. In this case, you go, okay, we have a good basis on the real estate. However, what happens in the case of a vacancy? And now you have to look at what that's going to take from a capital expenditure point. How much in tenant improvements are we going to have to do here to attract a new tenant? And my guess is, to be honest, a lot in this case. And so that was part of it. It was a little bit tertiary. This was not in the Kansas City market. This was far kind of the northeast Missouri here. So all those factors you kind of have to take into account. And eventually we said, look, we really strongly believe in this tenant. They're fantastic. They have just a crazy growth trajectory in an industry that's doing very well. However, we're not going to get, there are certain kind of structural pieces that banks kind of work around, and they just kind of put everything into a box. They're a little too structured. They can't make up for something like a more specialized build out with a very strong tenant a lot of times. So at the end of the day, we said, we believe in this. There's a little bit of risk here around the building structure and how it's built out. But our lending partners are not going to come in at favorable rates. They're going to say, hey, we're going to have very low leverage, very high rates because we perceive this as a much higher risk. So at the end of the day, you walk away. You just say, look, this doesn't work.
Let's assume that those unique structural aspects of that building didn't exist, and it was just four walls and a roof like a typical industrial building is. However, we know that this is in a tertiary market. It's somewhere a rural location. If there were to be a vacancy, might be smaller pool, obviously a much smaller pool of potential future tenants to take over that facility, what have you. Would that also have been a potential consideration just to pass on the deal just due to that inherent risk?
Yeah, you have to look at all the pieces there, but it's certainly when we've done deals in primary markets and deals in tertiary markets.
Sure.
And we can get comfortable in a tertiary market. We just closed on a portfolio in a somewhat tertiary market. And the reason we could is we look at the basis of the real estate first, and then we look at the strength of the tenants after that. But ultimately, you have to go, okay, if I come into this worst case scenario where they file Chapter 7 and move out, and I have empty buildings, what am I holding? What kind of rents am I at? If market rent is at $5 a square foot, and I have these guys leased up at $4, okay, I feel pretty good about that, right? And I'm also going to look at, during my due diligence phase, at what's the vacancy rate in that market? Is there a lot of inventory sitting out there? Okay, that's a little bit more risk here. But if it's tight, and generally you don't see a lot of construction in these, new construction coming along in these tertiary markets, but if it's pretty tight and I'm below market lease rate, I feel pretty good about that scenario. As unlikely as it may be, you still have to kind of walk through that in your your mind and go, what does that look like? Where are we at from that point of view? But there's, that's, I'm taking from day one to kind of a going nuclear worst case scenario, of course.
Yeah.
And what we're trying to do is build in as many layers of mitigation in between as we can. So that's where the lease comes with quarterly financial reporting, right? Here's that 4-property portfolio, and they say, we're starting to see some weakness. You're going to call them up. What's happening there? What's going on? Oh, it's a labor shortage. We can't hire people right now, and they got new orders coming. I just lost 2 people, and I can't find anyone who wants to work. That's a common complaint out there today, right? Everyone knows it. So in that case, let's just say that's temporary, hopefully a temporary issue. But hey, maybe we lost some customers, and now we're kind of struggling here. Maybe we can try to work with them. Ultimately, their success is ours, and we may say, hey, if there's some kind of temporary issue or like the labor issue, maybe we defer rents for 3 months or something like that, and recapitalize that over the course of the lease, right? And maybe there's a little bit of value add there, right? Hey, once you're back up and running, now your NOI is a little bit higher because you've recapitalized some deferred rents. There's creative ways to do it and work with them, especially when you have a portfolio like that. You could say, how about this? Maybe you guys consolidate into 3 properties, and we work something out with the lease rate there. It's a little bit higher to help compensate, and we find a new tenant for this 4th property. And at least the whole thing isn't going tanking at that point, right? You have 3 properties rents coming. So anyway, long story short, is there's a lot of creative ways to kind of mitigate that risk along the way.
Got it. No, I appreciate that. I know before we start recording, I'd asked you, I'd asked you if there's a lot of competition from larger institutional buyers in this space, and you had answered it. Yes, there is. However, there's a kind of a unique part of this space that you guys play in, and so I guess I'll just re-ask it. How do you guys compete against larger institutional buyers that typically have a lower cost of capital than what you might have? So how are you guys out there still buying?
Institutional buyers, many of them are really kind of restricted to just because of the amount of bureaucracy there. And, management will say, hey, to our acquisition teams, we're going to stick to primary markets only, let's just say, or we're going to stick to credit tenants only, right? And that's a big one there. A lot of them going, hey, we're looking for net leased assets. We're only going to deal with credit tenants. So these are people with a credit rating issued by, Moody's or Standard & Poor's, and they have a corporate bond credit rating. And that kind of leaves out all these private companies, all these privately owned, many of them, family owned, many of them private equity owned. And so there are these companies out here, like some of these I just mentioned, that are 70, 80, 150 plus year old companies that have been around, and they're privately owned. And you go, there's a perceived level of risk there, though, because you don't know anything from the outside. If a broker brings you that offering, you're going, okay, they tell you a little bit about them. They're in some manufacturing space. Maybe they give you a little bit of financials, but you don't really know much. You don't know where this thing should trade, right? So it's for us, it's always kind of this game with brokers to kind of get as much in financials as possible, signing NDAs and trying to get as much as you can to figure out where this thing probably should be. And then hopefully getting an offer accepted. And then from there, now you're really off to the races on that due diligence of the financials, because again, there's a lot that we don't know. And we've walked away from plenty of deals because you found out things that just are too crazy. You walk away and you find out, hey, they have an 80% of the revenue is coming from one customer. Okay, this is wild. We want no part of that. It's a house of cards waiting to fall. One contract goes away and boom, now you can't pay rent. So, so there's always that. And, hopefully that kind of answers the question.
Yeah.
But
No, absolutely. And what I meant to ask you a couple minutes back, what is your typical hold period? MAG Capital Partners, how long do you typically hold these individual assets? Is there a standard 3 to 5, 5 to 7? Anyway.
No, not exactly. I would say the sale-leasebacks, might be, I always kind of say it's an average of 4 or 5 years. You have a 15 or 20-year lease that you're putting into place usually. So 4 or 5 years is pretty comfortable for us. We're enjoying cash flow during that time. It's comfortable for investors. We've had some where we target 5 to 7 years because we go, look, here's a really strong tenant, and actually we're not getting quite the amount of yield or quite as good of a deal as maybe you could find on a different deal. And because of that, we're going to hold for a little bit longer and build that value over time. So we are going to be able to see, average NOI or sorry, ROI in the high teens, I'll put it that way, right?
Okay.
But maybe it's going to take a little longer. And then we've had, just recently a spat of a couple deals that have come to us off market, and we're getting a really good deal because we need to execute on some certain requirements by the seller. But hey, we're going to hold this one for 1 year, maybe 6 to 12 months, 1 to 2 years, something along that line. And we'll bring in investors and say, hey, this is going to be a short turnaround. Let's get ourselves lined up here because we got a great opportunity.
Beautiful. How about the tax advantages? We got to hit on the tax question. You mentioned cost seg studies. I will argue that mobile home parks are probably the most tax efficient vehicle that exists out there today. However, I do not know anything about the industrial side as far as bonus depreciation and what have you. So maybe speak to that. Assuming that you guys are doing cost seg studies on some of these properties.
Yeah, you're going to do cost seg study on every property, every acquisition we make, we do.
Okay.
So, what you get in that year one depreciation, though, is probably different from asset class to asset class.
Sure.
I'm not sure where, you'll have to tell me where mobile home parks are getting. And
about 76 to 78%. It's pretty high.
Okay, that's great. Yeah, we find anything from 40 to 70%.
Okay.
So it's kind of in the mid range. And yeah, I think multifamily probably comes in the highest from that year one. I mean, I've heard of some pretty crazy numbers in the 90 plus percent. Anyway, I can't speak to that. That's not what we're focused on here, but that's what I've heard of a little bit. So yeah, we're loading a lot into year one, but for anything that's not loaded into year one, you got to remember, as these, the cost segregation studies are done, they're finding some things that can depreciate in 12 months. They're also finding a lot of things that can depreciate over 60 months, 5 years, right?
Mm-hmm.
So usually if you're not getting as much in year one, you're usually going to see a pretty nice sort of tail end on years 2 and 3 and 4 right behind that.
Yeah, no, fantastic. And what else haven't I asked you that you feel is relevant as it relates to, the sale-leaseback strategy?
I think you kind of asked about sourcing deals, but I always find, part of how we source deals interesting. And I think right now, especially, it's important as people are looking around, they're going, look, real estate's, it tends to look really high in some areas. How do you find a deal? And this is what people are asking us, like, hey, I'm looking at houses. I don't want to get a bidding war on some house here. This doesn't feel like investing. It feels like throwing dumb money around. And I couldn't agree more. So how we're sourcing deals and how I see the kind of the future of our acquisitions pipeline, I kind of talk about a little bit. But we get a lot from brokers, and we kind of talked about this earlier. I don't have a call team here calling up businesses saying, hey, you want to sell your property? But we do have a little bit of off market. Sometimes you just have a network. Someone's got a company, they've never heard of a sale-leaseback, and they said, oh, I would love to stay put and sell my real estate and have some money for the growth of my company. But a lot of times brokers are bringing this, but the interesting side is private equity groups. These guys are out there and they're active as ever, really. And if your kind of listeners aren't aware of this, I mean, you have a lot of people who've built great companies and they're baby boomers and they're getting to retirement age and they're going, okay, my family's not interested in taking over, or maybe they're more interested in selling this thing so they can cash out too and they can all live happy, rich lives together or something. So they're out there finding these private equity groups are finding these opportunities with businesses that are ripe to sell, and especially in the manufacturing space, especially in these industrial types of businesses, because frankly, a lot of Gen Zs and millennials, like, they're not interested in this as much. They're more interested in tech. All these companies are telling us the same story. Hey, no one wants to get into a blue collar industry, even if you're owning it and making a great living. So these private equity groups are taking advantage of that. And what they're finding is, hey, we don't want to tie our capital up in real estate. So they come to us and we get a lot of off market opportunities, and they say, look, we're buying this company over here. It comes with the real estate. If you can work with us and simultaneously do a sale leaseback on the real estate as we close on the business, then we'll work with you on price and yield and find something that's equitable, because that's a big ask, right? Yeah, they need to know that they have a really experienced operator that can do that, because there's a lot of things to manage here. Environmental reports, especially when it comes to industrial. What kind of background of solvent use and plating were they doing, maybe there, whatever it might be that could, draw some risks. But all the other pieces, as getting debt lined up, equity lined up, all these pieces. And when someone says, I need you to close exactly with me on, January 7th, you're not going to do that with an inexperienced operator. You're really relying on that partner to get that done. So They know we have a track record. They know we can get it done. So this is important for your listeners to know as they're looking for deals, or if they're just looking to invest with a sponsor. How are they finding that deal? Are they just out there competing with everyone else paying top dollar? And we're finding a lot of opportunities where we're able to get a decent entry point because we have this ability to execute that they're looking for. Again, financing transaction, or a private equity group looking for an acquisition partner as they acquire a company. Both of these don't have time to go up to open market and go to the highest bidder. They really don't. They need a reliable buyer.
What would you say the proportionate share of incoming leads? Is it now mostly from the private equity side, or is it equal amounts between just private sellers and the PE firms?
Probably 50-50. Yeah.
Okay. Yeah.
Roughly there.
Well, good deal. Well, one last question I had for you, Drew, before we work to wrap things up here. Most folks only ever like to share the details of the deals that just went perfectly, the ones that just exceeded expectations, yada yada. Right? I mean, it's always exciting to talk about all the great deals that we made, the most money on and had the highest returns for our investors. But how about the most challenging deal that comes to mind for you? The one that kept you up through the night, gave you gray hairs, lost some hair, what have you, right? Added that unnecessary stress to your life for one reason or another. When I speak to those things, what deal comes to mind? What happened? What were the complexities? And ultimately, what would you have done differently second time around?
More of my gray hairs come from the acquisition side. A lender, a bank who will leave you at the altar 2 days before closing or something like that. That's what kills me. But no, we've been really fortunate. If I had a war chest of battle stories, we probably wouldn't be in business today. But I'll tell you a little bit of one. We had a sort of office industrial flex property in Texas, and the tenant started to show some weakness. And I'm going to leave it a little bit high level here because there's some
Sure. No, that's fine.
Involved. But essentially, there was some weakness in the credit of the tenant. And again, this is why we want to monitor their financials, right? So as we're watching this tenant, we're going, this doesn't look great. You're starting to see blood in the water. And essentially, it was kind of came to the point where you go, okay, are we going to white knuckle through this thing? That's not our style. That's not what we want to do. We want to preserve capital. In a situation like this where we can sort of see things unfolding, we took an exit, and we still were able to have cash flow and even a little bit of profit. Not much on the back end, frankly, because of this weakness starting to unfold, that we exited. And you know what? Let's get everyone's capital back plus a little bit of profit. I mean, I think we still ended up having like a 12% average annual return. So certainly not a loss. All of our investors are great. They're like, hey, no big deal. Let's move on to the next one.
Sure.
If this is the worst case scenario you guys have had so far, awesome. And people kind of appreciate that. You go, let's not white knuckle through this. Let's not hope and pray. Let's, take some action here because we've been able to enjoy some cash flow for a couple of years. Let's take our wins and, go find another opportunity. So, but for, a couple months, you're kind of looking at their financials going, oh boy, are we overreacting? And you kind of want to sort in. And in hindsight here, actually, I'll give you a little bit, fast forward to today. In hindsight, this company's recovered. Okay. So do we make the right decision? I guess not, right? I mean, hindsight's 20/20, but ultimately at that time we were saying, let's preserve capital. I kind of explained this already.
Yeah. I mean, a 12% return is something to shake a stick at, right? It might not have met, the initial expectations or performer that was set forth, but again, 12% is nothing to shake a stick at, right? Take it and move on to the next deal. So.
Absolutely. Yeah. So it's, again, if that's the biggest war story I have, then I mean, I'm very, very happy to tell it.
Yeah, no, fantastic. Well, I appreciate you sharing that and being a little transparent there. I mean, that's phenomenal. Drew, it's been a lot of fun having you on the show. For those that want to learn more about you and MAG Capital Partners, where's the best place to find you?
Yeah, they can email me, Drew at magcp.com. That's magcp.com, or you can go to our website, magcp.com. Find us there. You can, if you're interested in finding out more, there's a little investor entry form if you'd like to get in touch with us.
Okay, fantastic. Well, Drew, it's been a lot of fun having you on the show. Appreciate you coming on.
Yeah, thanks a lot. It was fun.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success.